Welcome to This Explainer. Today, we're diving into the framework of Warren Buffett 12 mistakes every investor makes, and we're going to explore one of the most fascinating paradoxes in the entire financial world. We're looking at exactly why brilliant, highly educated people so often fail spectacularly at investing, while one famously stubborn man from Omaha got obscenely rich by essentially buying boring companies and taking long naps. We have to start with the ultimate paradox here. On one hand, you had literally the smartest guys in the room. We're talking Nobel laureates who won their prizes specifically for figuring out how financial markets work. And yet, in 1998, they blew up so badly they lost $4.6 billion in a matter of weeks and nearly dragged the entire global financial system down with them. On the other hand, we have the nap guy, Warren Buffett, who quietly amassed a massive fortune simply by avoiding a specific set of behavioral traps. Same markets, same years, completely different outcomes. So what exactly is the underlying cause of this paradox? Well, we're calling it the genius tax. It's the incredibly expensive price you pay when you try to be smarter than the market instead of simply being more patient than it. Throughout this explainer, we're going to follow our avatar, Henry. He's a sharp 34-year-old guy who dutifully reads the financial news every single morning. But because he's human, he is about to walk into every single one of these 12 mistakes and pay the ultimate genius tax. Part 1. The action trap. Mistake number 1 is trying to time the market. Waiting for the dip, buying at the absolute bottom, selling at the top. You know, it feels like the smartest possible move, but the data shows that the market actually does most of its heavy lifting on a tiny handful of explosive days. If you just leave your money alone for 20 years, it grows beautifully. But if you miss just the 10 best days out of those 2 entire decades, you cut your returns completely in half. It's a really harsh lesson that Henry learns the hard way after panic selling during a crash, only to miss the historic rebound just a few weeks later. The reason timing the market is such a trap is because those best days love to hide right next to the most terrifying ones. Even the greatest investor alive admits he cannot predict short-term movements. Buffett says stock forecasters just make fortune tellers look good. I mean, even during the 2008 crisis, he flatly admitted he had absolutely no idea whether stocks would be higher or lower a month or a year from then. Let's move on to mistake number 2, paying high fees. Consider a $100,000 investment over 30 years. With 0 fees, you land somewhere around $760,000. A 1% fee drops you down to $570,000. But introduce a 2% fee and you're left with just $430,000. Think of that 2% fee as a silent roommate who pays no rent, never does the dishes, but over 30 years quietly steals 43% of your total wealth. Buffett was actually so confident about how destructive these fees are that he put $1 million on the line. He bet that a simple, cheap index fund would beat a hand-picked basket of 5 elite hedge funds over 10 years. And the final score wasn't even close. The boring index fund was up 125.8%, while those brilliant hedge funds, after their massive fees were taken out, averaged just 36.3%. It was essentially a public execution of the idea that expensive Wall Street managers can consistently beat the market. Part 2, ego and the crowd. Let's group a few of these behavioral mistakes together into what we can call common ego traps. Mistake number 3 is letting fear and greed run the show through overtrading. Active traders actually underperform by over 6 points a year, simply because hitting that buy or sell button gives them a false sense of control. Mistake 4 is letting your ego convince you that your gut intuition is somehow better than actual data. Both of these traps are completely driven by emotion, not logic. Which brings us to mistake number 5, investing outside your circle of competence. Like Buffett says, risk comes from not knowing what you're doing. Henry falls right into this by confusing his love for a product with an actual understanding of the business. Look, just because you like a company's coffee or read a flashy headline about their AI technology does not mean you understand their profit margins or their competitive threats. When you step outside your circle of competence, a rising stock price isn't validation, it's bait. This spills directly into mistake number 6, the falling knife trap, which is really all about anchoring. Say Henry buys a stock at $50. It drops to $30. Instead of reevaluating the business itself, he anchors to that $50 price tag in his mind. He thinks 30 is a bargain, so he averages down. He buys again at 20. He is tricking himself into shoveling good money into a dying business just because it looks cheaper today than it did yesterday. He completely forgets that a stock can fall 90% and still be wildly overpriced if the underlying company is rotting. Mistake number 7 is blindly following the crowd. Buffett uses this brilliant Cinderella analogy to explain market manias and hype-fueled group chats. In a bubble, everyone knows that staying too long turns your investments back into pumpkins. But the party is just so intoxicating that everyone promises themselves they'll leave exactly 1 minute before midnight. The problem is, in this particular ballroom, the clocks have no hands. The crowd can get you into a position, but it will never, ever tell you when it's time to leave. Now take all that emotion we just talked about and pour gasoline on it. That is mistake number 8, using leverage or borrowed money. A normal 25% drop in the market? That happens all the time. You sit back, sip your coffee, and just wait for it to recover. But if you borrowed money to invest, that exact same 25% drop can wipe out half your actual wealth and trigger a margin call, forcing you to sell at the absolute bottom. This is exactly how those Nobel laureates we talked about earlier lost $4.6 billion. Leverage doesn't just raise your ceiling, it literally saws off your floor. Part 3. Rethinking value and time. This brings us to a crucial point. Mistake number 9. Confusing price with value. Price is just the flashing number on the screen. It's set by the moods and fears of millions of people on any given Tuesday. Value, on the other hand, is the actual cash the underlying business generates over its life. When a stock falls 30%, the crowd stares at that red price tag and panics. But if the underlying value of the business hasn't actually changed, Buffett looks at that exact same red number and views it as a clearance sale. Mistake number 10 is selling winners way too early, mostly because people completely underestimate time. Take a look at the compounding curve. Year 1 feels flat and honestly pretty boring. By year 15, the engine is finally warming up. But by year 30, you get this massive vertical explosion where 60% of your total wealth arrives in that final decade. If you get impatient and sell a great business at year 15 just to lock in a small profit, you're basically walking out of the theater right before the movie gets good. And this is exactly where Henry makes his very first brilliant move. He looks at a stock in his portfolio that happens to be up 50%. He feels that deep human itch to sell and lock in the profit. And he completely ignores it. He remembers Buffett's golden rule. Our favorite holding period is forever. As long as the business stays great, you don't pull a compounding machine out of the ground just to admire its roots. Mistake 11 is botching diversification, and people often misunderstand Buffett on this one. If you are a true expert who deeply understands a few wonderful businesses, heavy concentration makes perfect sense. Diversifying into mediocre companies just to feel safe only waters down your best ideas. But for everyone else, people who don't analyze balance sheets for a living, maximum diversification through broad, low-cost index funds is absolutely the smartest move. It's not a contradiction. It's simply about matching your strategy to your actual level of expertise. Now for mistake number 12, which is the most quietly expensive one of the whole bunch, hiding in cash. Take the number $55,000. If you park $100,000 in cash, because the market feels scary right now, a totally normal 3% inflation rate will quietly bleed your buying power down to just $55,000 over 20 years. Nothing crashed, nothing dramatic happened. Your statement still says $100,000, but you lost nearly half your real wealth. Cash is the one asset guaranteed by design to lose value over time. Part 4. Consistently not stupid. So how did Henry finally turn it all around? Well, he stopped being an anxious overtrader. He let his winners run. He did the humble thing and sold all those random stocks he couldn't actually explain. He moved that money straight into low-cost index funds. And most importantly, he sorted his cash into a proper emergency fund and then literally just put the brokerage app down. He didn't magically gain 20 IQ points. He just stopped being his own worst enemy. You see, wealth does not require you to be a genius. Buffett's longtime partner, the late Charlie Munger, summed it up perfectly. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid. Avoiding these 12 mistakes isn't about brilliance. It's about having the temperament, the patience, and the discipline to outlast the market rather than constantly trying to outsmart it. So, I'm going to leave you with this final thought to consider. Are you ready to stop paying the genius tax and just take a nap? The most expensive mistakes are rarely the loud, dramatic ones. They're the quiet, comfortable, reasonable-feeling ones. Embrace the boring, quiet path to wealth that made Warren Buffett a legend, and let time do the heavy lifting for you.